Hey everyone, it's Brett with Investing on the Go. I help everyday people take control of their money by sharing simple, actionable personal finance videos, no fluff, no complexity, just what has actually worked. Each week, I share strategies to help you budget smarter, save more, and invest with confidence. So if you're ready to master your money, hit subscribe and go down below, give this video a big old thumbs up. Let's grow together. Today, we're going to be covering why I buy SPYI and QQQI for income versus selling calls on SPY or other ETFs. Say I want to become financially independent, retire early. These funds or ETFs that we're going to be talking about in this video is what has helped me get there sooner. Real quick, before we jump into why I prefer SPYI and QQQI, I just launched a free Discord community where we can all talk about personal finance together. It's a judgment-free space to ask questions, share wins, and share personal finance experiences together with other people on the same journey. So whether you're just starting out or investing already, you're welcome to join. Join us using the link down in the pinned comment or also in the description down below. All right, let's go ahead and get into the journey with covered calls. The covered call dream. I've spent the last years trying to perfect the art of selling covered calls on my own SPY shares. The goal was simple, right? Generate a steady, reliable income stream from the S&P 500 SPY that I already own. On paper, it was the perfect strategy. But the reality was that the income was choppy, unpredictable, and I live with this nagging fear that my core holdings, the very foundation of my portfolio, would get called away right before a massive rally. And then guess what? It happened. My shares got called away. I missed a huge leg up in the market and I was left with a pile of cash that was suddenly way more expensive to reinvest. That was it. That was my breaking point. I knew I had to find a better way. So in this video, I'm going to go ahead and be discussing and breaking down that exact moment I switched strategies and why a special kind of ETF called SPYI and QQQI now give me a more stable, high yield income stream, all without the constant stress and the risk of my shares being sold out from under me, and I still get capital gains since purchasing into these. So no more expectancy, here I'm not having this anymore. The reality as I move to SPYI and QQQI, the expectation and reality has now become something more like this. So we're going to go ahead and go over the frustrating reality of selling my own covered calls. Let's be honest, the idea of selling covered calls on SPY, QQQ is so appealing. You hold on to the 500 largest companies in the US all in one ETF, and you can kind of rent out those shares by selling call options to collect a weekly or monthly paycheck. It's sold as the perfect way to squeeze a little more juice from the orange, and my journey started with the exact same optimism. I set an income target for myself as a, say, goal or something as a test, a number that I needed to hit to cover certain monthly expenses, and I started selling monthly or then weekly out of the money calls on my SPY position. The first couple of months, they were great. Volatility was decent. The premiums I collected were added up. I made several videos back in 2022 of generating $3,000 to $6,000 in monthly call options, and I thought I had really cracked the code. But then the market hit a lull. The volatility just kind of dried up, and so did the income. The premiums for some calls were suddenly a fraction of what they were. My income stream, which I was kind of testing out and would soon be relying more on, turned unpredictable. To hit my target, I had to make a tough choice. Either I would sell my calls much closer to the stock price, which massively increased the risk of my shares being called away, or I could go ahead and sell off a portion of my shares to cover the remaining portions of my expenses. I've seen a couple of videos from doing this. I've seen a few videos from Ben Felix talking about just buy the underlying assets, sell call options, and then sell the shares that you need to cover expenses is a better option. But that doesn't work out, as you soon lose shares. If you go under a specific amount, you could no longer sell covered call options. So the turning point, shares got called away. Doing this method was stressful. I was constantly checking the market, trying to time my trades on weekly calls, either on Tuesdays or Fridays. It wasn't passive income anymore. It felt like a second time-consuming job. But the real pain point, the thing that truly got me, was the constant fear of missing out, the FOMO. I remember 1 month vividly back in 2022, the market was trading sideways and I sold my calls just like I always do. Then out of nowhere, a surprise rally after an economic report hit, the market just ripped higher. My SPYI shares blew past my strike price. I had to sit there and watch the S&P 500 climb higher and higher, knowing that my upside was totally capped. Sure, I could buy back my calls, keep my shares, but it would cost an arm and a leg. At expiration, my shares were called away. And sure, I had my premium and that small gain, but I was stuck on the sidelines with cash while the market kept running. The frustration was immense. In order to buy back in, I had to buy my shares at a much higher price than where my shares were sold. That one event didn't just cost me my potential gains, it actually eroded my core position. I own now fewer shares and fewer positions of my SPYI than I ever did before, which meant that the next time that I went to sell call options, my income potential would be even lower. This was say back when I had 400 plus shares, and then during the rip up, it pulled away those 400 shares and I wasn't able to buy back in at say 400 shares. I was able to only buy 396 or 394, and being unable to write 4 covered calls and instead having to write 3 covered calls, that changes the dynamic quite a bit. So it felt like I was running on a treadmill, working my tail off just to stay in the same position and sometimes even going backwards. I realized that my hunt for consistent income was actually putting my entire foundation at risk. Now, searching for a better way, the aha moment discovering SPYI and QQQI. So I went back to the drawing board after that disaster. I still believed in the S&P 500 and the income potential from options. I just knew that my do-it-myself, the DIY, was broken. It was too inconsistent, too time-consuming, and the risk of my portfolio shrinking was just too high. So I started looking for something more professionally managed, something that could run more passive option strategy for me, and that's when I stumbled upon the NEOS S&P 500 High Income ETF, ticker symbol SPY, and the NEOS NASDAQ High Income ETF, ticker symbol QQQI. At first, I was kind of skeptical, right? I've heard of these in the past with JEPI, JEPQ. I mean, there are just tons of covered call options out there, but the more that I dug in, the more I realized that SPYI and QQQI were built differently. It was almost like it was designed to solve the very problem I was having. SPYI holds the stocks within the S&P 500 just like SPY, and QQQI holds the stocks within the NASDAQ 100, just like QQQ. And like my old strategy, it sells call options on the index. But here's the critical differences. It's actively managed by a team of professionals whose entire job is to navigate the market and optimize the option strategy. Second, and this was the key for me, SPYI and QQQI don't just sell covered calls, it implements a call spread. This means while it sells a call to bring in income, it also buys another call option further out of the money. This strategy still produces a net credit, that's our income, but it also lets the fund keep more upside potential if the market does happen to have a strong rally. These ETFs were built to prevent the exact scenario that burned me, having my upside totally capped and my shares called away. This was my aha moment. I realized I didn't have to choose between high income and growth. A strategy existed that aimed for both. So I went ahead and got what I wanted, right? I still believe within the S&P 500 and NASDAQ. I wanted consistent income. I wanted something that was more passive, not having to write my own call options every single week. If I was out somewhere on a Tuesday or a Friday and I wasn't able to write this, I wanted something that was truly passive. And while I'm not sacrificing all growth, there is some upcap potential. So this is where I needed that smarter option strategy with the NEOS S&P and the NEOS NASDAQ high income funds. Now we are halfway through this video, guys, so do a quick check-in down in the comment section down below. What is your biggest frustration with income strategies? Is it the inconsistency, the risk, or something else? I read and respond to every single comment out here, so drop a comment down below. Let me know, do you guys invest into any income style ETFs or funds? I do see a ton of individuals out there buying into these crazy ETFs and losing tens of thousands of dollars and losing their NAV, all at the risk of high income, but here I'm not trying to do that. We'll talk more about these, right? So let's go ahead and do a deep dive into why SPYI and QQQI work for me. So my income strategy here, switching to SPYI and QQQI totally transformed my income strategy, and it all comes down to these 4 things. We're going to go ahead and talk about income consistency, the simplicity, and huge thing right here, tax efficiency, and the power of return on capital. The upside for all four of these is pretty much positive, 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 positive. Now, why SPYI, QQQI work for me? First, let's talk about the income consistency. SPYI and QQQI are designed for high monthly distributions. As of late 2025, their distribution yield is in the 11 to 14% range. Compare that to SPYI's dividend yield, which is currently right around 1.08 and QQQ at 0.47. The income from SPYI and QQQI have been remarkably stable, giving me a predictable monthly cash flow I can actually plan around, unlike the wild swings I got from my do-it-yourself premiums. This consistency comes from having a professional team actively managing the options portfolio, constantly adjusting to keep that income stream steady. For someone looking to generate, say, $1,000 a month, an investment of around $100,000 in SPYI could get you there, a target that's incredibly hard to hit on your own. So here is an example that I went ahead and built out. You have $100,000 that you want to invest. Now, we can invest it into SPYI, which yields a roughly 11 to 12% yield, depending on where you're buying it. Right now, as of close on Friday, it's trading at $52.29. We will be able to pick up roughly 1,912 shares, or spending $99,978 expected income every single month. Now multiply that by 200,000, 300,000, and so on. The SPY, on the other hand, right, it had a 1.08% yield. We can't really rely on that for any sort of reliant, and it's a quarterly dividend, so we can't count on that on a monthly basis. Now, if we do want to write one call option, we require 100 shares of SPYI, trading it currently at $671.93. It would cost us $67,193 to contain 100 shares. Now, we would have $23,000 that were purchased, say, into SPY that wouldn't be called away, right? They would just be able to have that upside. They wouldn't be capped. We would be selling the SPY at a 30 delta, which would generate roughly $266.70. Now this premium is unpredictable. Right now, as of Friday as close, I went ahead and wrote it out where I would expire it on 21 November at a strike price of $681, but this is very limited upside right now. We could break up to this upside again. Right now, the markets are trending. They're really it's consolidation right now. Right now, we're holding above that 50-day moving average. We've been consolidating sideways for a bit. There's been a bunch of individual companies kind of falling out, but they're kind of bottoming out. So right now, we're just kind of consolidating. And if, for whatever reason, the share price next week, we're going into this next week here, it skyrockets past 681 and closes at 681 or 682 or 683, right? We're going to have to sell out all of our shares that we own, and all the shares, the 100 shares here that we had that covered call option written on. Now, if we get lucky and we write roughly a $266 covered call every single week for 4 weeks, we could generate $1,066.80, but at the same time, we could just be invested into SPYI and generating roughly that $1,000 without any sort of other work, right? We're not having to write or run covered calls. We're not having to be stressed out over the strike price moving up or down, or the option expiring in the money or out of the money, right? None of that matters. We're just invested into the individual holding itself. Now, why SPYI and QQQI work for me? We're going to go ahead and talk about the simplicity. Second, the simplicity is a game changer. My days of staring at option chains, stressing over expiration dates, and worrying about my shares are over. I just buy and hold SPYI and QQQI, and all the complex work is done for me. This has freed up so much time and mental energy. The expense ratio for these funds are 0.68, which for me is a small price to pay for a professionally management and peace of mind. When I'm taking a look at my real estate business, I have a property manager. They take 10% of my rental income per month to manage my rentals. So paying 0.68% is a fraction of the cost to get the income management that I want from these funds. So I still net a positive return when the market is doing well. While I do cap my upside, the amount of equity that I have invested into SPYI or QQQI is only enough to create the foundation that allows me to fire right now. Right now, in my 40s, I'm able to I'm able to be financially independent, retire early. My wife hasn't worked for the last 6 years. I stopped working back in February of 2025, and we've been testing this route out. I've been able to spend more time with my family, with my wife, and picking my kids up from school, going on field trips, being an active participant, and doing community service at school during events with them. I've been able to work on this YouTube channel, my other YouTube channel, other projects that I want to be a part of, and I'm just spending more time living my own life right now. Now, the majority of my own net worth is still tied 55% to real estate, 25% is in these high yield funds that create that foundation, and 20% is still invested into long-term growth that tracks the S&P 500 or a few individual growth and a few growth oriented individual stocks. So it's not like I'm dumping everything that I have into these specific funds. It's just enough to cover my monthly expenses. Anything that's not covered by these, I have other income that's able to be covered, it's able to be generated and used for expenses to kind of cover those tiny little missing pieces. But this creates a solid foundation that doesn't fluctuate. It still generates a nice, consistent monthly income and a yearly return. Any income that is not used, anything extra is being able to be reinvested, buying back more shares for either additional income going forward or growth. Now, here on the bottom, I went ahead and posted the SPY and the QQQ comparisons. Here on the left-hand side, we have SPYI and SPYI comparisons. So at the very top, you'll notice in the purple, that's the total return with dividends reinvested in the SPY is at 77.22. In the orange right here, we have the SPY as just the price change, right? No dividends being reinvested. You take the dividends, you take it and do whatever with it. It's at a 70. Now, here in the blue, this is SPYI total return. If you were to take the price appreciation and you took all the dividends that were paid to you and you reinvested them back into the underlying asset SPYI, you'd have a rate of return of 57.19. So here down at the bottom is the price appreciation of just the price itself since this ETF was created back at late 2022. But I'm going to go ahead and just say as of 2023, this has returned roughly a 9.32%, or I'm just going to say a 4.15% average return per year. So I'm not having any sort of net asset devaluation. I'm not having any erosion, right? Net asset value is still remaining there. If I put $100,000 into this fund, it has generated $9,320 over that course of the year while paying out a dividend. If I was paid out a dividend and I covered all my expenses and I didn't need to use any more of that dividend for my expenses, I could buy back in more shares of this fund and make it have a higher rate of return. Not near as high as having that total rate of return, but maybe a 10%, maybe a 12%, right? I'd be buying back more shares. I would be getting paid out more income on a monthly basis and then have a higher rate of return as well. Over here on the right-hand side, we have the QQQ and the QQQI comparison. Here at the top, we have dividends reinvested. Again, the dividend on QQQ is at a 0.65. So you're not getting a lot. So there's not a big difference there between the total return, the price. But you see here that with QQQI here in the blue, with those dividends reinvested from QQQI, you have a rate of return of 39.44. So that's with dividends when you're getting paid out, they get reinvested automatically. So it's keeping pretty well with the underlying asset. Now, obviously, I'm taking the dividends and I'm using it to pay expenses, and it has a rate of return, say as of the last year, of 8.5%. So this was started back in 2024. It's returned, say, 4.25 on average over the last 2 years, which I'm not losing. Again, I'm not losing my underlying money that I've put into it. I'm making some. If I put $100,000 into this, by right now I have $8,000 $500 more, plus I've been paid out those dividends. Any dividends, again, that I'm not using on a monthly basis, I'm able to reinvest, either buying back into QQQI or QQQ or some other fund. It just really depends on what I want to do. And I've seen a lot of investors out there sharing screenshots of them buying into these other, I'm going to say, other high yield funds, covered call funds, where they've completely eroded their initial equity that they've invested into it. They invested $100,000 into it. Their actual equity is only worth $60,000, $40,000, $20,000. So yes, they're making thousands of dollars on a monthly basis in dividend, but they're eroding their actual asset value. The amount of equity that they initially added into the fund, it's essentially getting paid back to them, plus they're losing even more beyond that. So I'm buying into stuff that not only grows my asset value, my initial deposit, but I'm able to still make a sizable amount of income from it. That's my goal from investing into these two ETFs. Now, why SPYI and QQQI work for me? Tax efficiency. Let's go ahead and talk about the big one here. The third pillar of why SPYI and QQQI really separate themselves from my do-it-yourself calls and even other income ETFs is the tax efficiency. This is the secret weapon. They don't use options on the ETF itself. They use options on the index, SPX. These are classified by the IRS as Section 1256 contract. This special rule means that any gains get a blended tax rate of 60% are treated as long-term capital gains, which, depending on your tax group, are 0%, and 40% are short-term, no matter how long you've held them. This is an amazing tax efficiency thing right here. When I'm selling my own SPY calls, all that premium was taxed at my higher short-term rate. This 60-40 rule for SPYI and QQQI mean a significantly lower tax bill, so more of that high yield stays in my pocket or is reinvested without having to pay taxes right now. Now, let's go ahead and go over the power of return of capital. Here's the real kicker. A huge portion of SPYI's and QQQI's monthly distributions have been classified as return of capital, or ROC. Return of capital is not immediately taxable. Instead, it just lowers your cost basis in the ETF. You defer the taxes until you sell your shares, and at that point, it's taxed as the capital gains, which, if you've been holding for over a year, could be much better long-term rate. For the year of 2024, nearly 94% of SPYI distributions were classified as return to capital. This powerful combo of Section 1256 contracts and return of capital means that SPYI is an incredible tool for generating tax-efficient income, especially in a regular brokerage account. And I'll be honest, I have chosen to sell at times of volatility, staying in cash during small periods, and buying in at more opportunity times, especially here when the market is trading near all-time highs. Now, this sometimes does create a wash sale where I made a small loss, but I buy back in when the price is even lower, not able to claim the loss, but overall lowering my average price to buy back in and increasing the amount of shares I own slowly. While these do trigger taxable events, I have no other W-2 income to add to these events to, so if I need to, I am able to write off a good portion between my YouTube business and my real estate business against my sort of taxable events that do take place. So that's why I kind of do these little things. I don't mind selling out, doing a wash sale, and just kind of lowering my cost basis a bit. And if the market moves down 1-2% and I'm able to buy back in those shares cheaper, it's a huge amount of shares that I'm able to acquire doing this route, especially when the market's trading at these all-time highs. I'm not doing it every single day, but there's days where the market rips down, and you can see it kind of ripping down during the day. I'd kind of sell off and I'll wait just a little bit. It doesn't have to be a whole lot cheaper. 0.25%, 0.5% on $100,000, $200,000, $300,000. It makes the big difference in how many more shares you're able to acquire. Now, some referral mentions. If you'd like to get your personal finances in order and start investing for your own income, or just start investing period, here are 3 tools that I personally use to keep my finances organized. Starting off with number 1, SoFi Money. You guys can get up to a $325 bonus 3.6% APY on savings plus checking, credit, and investing all in one place. Speaking of investing, if you deposit $25, you get a $25 bonus. Plus, you can join our $1,000 investment SPYI challenge or just any challenge right on any platform investing your first $1,000. Last but not least, we have Policy Genius. Get fast, affordable life, home, or auto insurance tailored to protect your family without breaking the bank. Now, the final comparison, SPYI covered calls versus SPYI. All right, let's go ahead and stack them side by side. With my old strategy of selling covered calls on SPYI, I had a choppy income that completely depended on the market volatility. I had the constant risk of my shares being called away, which capped my gains and literally shrank my core investment. The management was stressful, time consuming. It was a weekly, daily chore, and to top it all off, the income I made was taxed inefficiently. Now, with SPYI and QQQI, I get a consistent high-yield monthly income. The fund's call spread structure is designed to let me participate in market upside, so I'm not left behind in the dust during a rally. The management is completely hands-off, handled by professionals, and most importantly, the income comes in a highly tax-efficient package, thanks to those Section 1256 contracts and return of capital distributions. Now, it's true that in a roaring bull market, just holding SPYI will probably give you a higher rate of return, but my primary goals have shifted. I'm not chasing maximum growth at all costs. I was building a machine to generate reliable income. SPYI and QQQI let me do that without any sort of NAV erosion and without crippling downsides of my do-it-yourself approach. It's delivered impressive total returns since its launch back in 2022, 2023, even keeping pace surprisingly well with the S&P 500 and NASDAQ at times, all while paying me out those massively distribution yields. So right now, my expected income, just based off my SPYI and QQQI, is around $36,600 or right around there, right? I have other incomes as well that I generate that make up some differences in my expenses, such from real estate or other sorts of income. So while this creates a foundation and I'm able to just maintain with 35% of my total net worth, this still leaves a good portion invested into these high growth funds such as VU or into other individual high growth stocks. So that is going to be it, guys. If this video gave you a practical way to boost your finances this week or weekend going forward, do me a favor, go down below, hit that subscribe, and also hit the thumbs up button. It really helps more people discover these simple money strategies and tells YouTube to show you more of my videos. Also, next steps for you guys, go down below, download the free budget template in the description below. It's the exact system I use to track where every single dollar goes. Also, join our free Discord community at the link down below. Share your challenges you're taking, questions, connect with others on the same journey. I'm in there every single day. So if you'd like, drop a comment, let me know. What is your favorite strategy for generating income? Are you selling manually covered calls? Are you selling puts? Are you doing it yourself through income ETFs like SPYI, QQQI, or others? I'd love to hear your guys' results. If you guys are invested into other, covered call ETFs, let me know down in the comment section down below. Thank you all for watching. I will see you guys in the next one, and bye-bye.